Hey, welcome to FiscalVoyage. My name is Felix, and in today's video, I'm going to give you 6 examples on what to do when a stock that you buy drops 10-15%. These examples are my personal examples of what I've done. I'm going to show you positions of companies that I currently hold and that where I bought shares of this company, they've dropped. But before we get started with the video, if you're new to the channel, make sure to hit that subscribe button if you like it. So let's get started with my personal experience and the 6 examples. So here's my first example on Cummins Inc. So as you can see here, the green dots represents the time I bought shares of this company. So when I first initially bought shares of this company, I bought it at 9/11/2015. I bought 10 shares at that time. And then right after that, you can see here, the company or the stock price dropped 25%. So my total return was negative 60%. So I lost money right away. I bought shares of this company, but I did not panic. What I did was buy more shares, as you can see here. So let me lower the time frame here. You can see here I bought more shares. I bought 14 more shares at $89 versus my initial buy of 118. So when I bought these shares, the next few months it dropped, and then I actually was able to buy it at the bottom. Again, you can never time the bottom. I was ready to continue buying more shares if it were to go down, but as you can see, because I didn't panic, because I was losing money when I first initially bought shares, I didn't panic. I actually bought more. I then, if you look here from this time period to what it is since Friday close, you can see here 7/31, I closed at $193. I've gained a total annual rate of return of 17.6%, which includes dividends and capital appreciation. So my total return since that time period is 113%. So this is one example of my 6 examples that I'm going to show you, that just because when you buy shares doesn't, and when it drops, doesn't mean panic and sell it. It might actually mean to buy more shares because you've done your homework, and that's the reason why you bought shares of it. So let's go to the next one. So here's the next company that I've bought shares, and then the price dropped, and I bought more shares. Deere and Company, ticker symbol DE. As you can see here, as Friday closing price, the price was $176.31. And I first initially bought shares of the company at 6/6/2014. I bought 13 shares at $92. So let's zoom in here a little bit. So right away, I initially bought shares. The price dropped slightly from $92.02 to $85.57. So from that time period, that was a loss of 7%. So it dropped 7% since I first initially bought shares. So that's not a dramatic drop, but if we clear this, you can see here in 2009, 30, 2015, all the way to basically 9/30/16, a whole year, it was lower than my my average price. So if we use this as the average price here, to this point, I had a loss of 14%, total return of 8.7%, but I did not panic, even though it was basically flat for, you can see here, basically for 3-4 years flat. But when I bought it, it was flat for about 2.5 years. There was no price movement, but I believed in the company. I did my research, and I knew it was only a matter of time before the price of the company would increase. So if we look here around this average of $90 to what it is now, I have a total annual return of 13.2%. So my total rate of return is 112%. So it's a home run basically. And I'm going to continue to hold Cummins and Deere for the next 5-10 years because I love the companies, and I don't see them slowing down. But As you can see here, I didn't panic and sell because 2 years or 2 years and a half it was flat or doing nothing. I didn't panic and sell. What I should have done was buy more in this time period, but I always like to diversify and buy different companies because there's so many amazing companies. So I wasn't buying Deere, but I was buying other companies at this time period. But seeing, I should have bought more Deere, as you can see. But I'm happy with my current position, and as you can see, I've made money with this investment. I'm going to continue to make money because the company is going to be here for a while, and they're going to continue to make money, and I'm collecting the dividends. So let's go with the third stock. So here's the third example, Norfolk Southern Corp, ticker symbol NSC. As you can see here, I first initially bought shares of the company where the price was dropping, and I bought it in 7/17/2015 for $86.10. And then it dropped a little more, and then it picked up, and I was happy there, but then it dropped again. And in 2/29/2016, I bought 16 more shares at $75. But as you can see here from, let's zoom in here as well. As you can see here from this time period until here, I had a loss of annual return of 17% negative with a total rate of return of negative 11.1%. But again, I didn't panic. I believed in the company. I did my research, and I was happy that I had those shares. And because of that, if we go, let's say here, let's pick. Trying to find there. That's a good one there. Wait, let's see here. So if I go here to what it is now, I've averaged a total annual rate of return of 22%, a total rate of return of 157% since that time period, more or less from $80. So you can see that. Make sure you do your homework and analyze the company. Just because the stock price, you can see here, it dropped from here to, let's see, to the lows of here. It was, at that day, I was down basically 16.6%. So I was like, man, what a bad investment. I'm a terrible investor, right? No, I realized the company was undervalued, and I was happy with my position, and because it dropped, I was able to pick up some more shares at a lower price, and I just kept being patient, and eventually the market realized that the company was undervalued, and it started to pick up, and you could see that great rate of return from since I purchased shares. So let's go with the next example. So here's the fourth example, Union Pacific Corp. Ticker symbol UNP. As you can see here, I only bought one lot of shares. I wanted to buy more, but again, at this time period, I was buying more other companies. But as you can see here, if we get a little closer, I bought 13 shares at $97. If we go from that $97, let me see, I can move this. There it is. If we from there at that point, it continued to drop. It dropped all the way to 24%, negative 24% rate of return. So I was like, man. So it was basically half a year from what we got here from July to January. I was losing money for basically 6 months, right? And what I should have done was kept buying because of course, I saw earnings reports, revenue, net income, margin, all that stuff. I was doing my homework, and that's the reason why I bought shares. Should have been buying more. But as you can see here, from this point to this point, I have a total annual rate of return of 13.9 with a total rate of return of 93.9%. So this, I think, maybe by next year, it should be at 100% total return in only 1, 2, 3, 4, 5, 6, 7 years. So that's about average, and again, most of the times I make my investment is on the dividend. I like dividend growth investments. So these are not your high growth companies where, in 2 years or 3 years you hit 100%, but I'm very happy with the income that I'm receiving, which is pays for most of my bills. I actually could live off my dividends right now if I wanted to. but that's another story for another video. And so we look here, I didn't panic with this one as well. I bought it and it dropped, for 6 months straight before then finally picking up because the market realized that it was undervalued and the earnings were growing. So that's positive there. So let's go with the next company. So here's the fifth company, Target Corp, ticker symbol TGT. As you can see here, I've bought a lot of shares of Target because this is the time period where the retail apocalypse, no one's buying at retail, brick and mortars, Amazon is controlling everything. So that's what's causing these prices for Target to drop tremendously during this period. But I saw otherwise because I was looking at their earnings, I was looking at their revenue, net income, all that stuff, and I realized, wait a minute, this is actually pretty cheap. So if we zoom in here, I first initially bought Target. Let me see if I can get this here, but it's pretty hard. But around the end of 2013 or the beginning of 2014, I bought shares of Target. It was pretty flat for the year and actually lower here, as you can see here. And then it picked up, so I didn't buy it because then I realized it had a PE of almost 18 or 20, close to 20. So I didn't buy because I felt it was overvalued. But once, in 2017, the company share price dropped, of course, because of the retail apocalypse. No one's going to brick and mortars, Target, Walmart. They're no longer existing. They're not profitable anymore. But wrong. If you look at the reports and their financials, you can see that they're still making money. So I bought a whole bunch of shares here. As you can see here, 50. Let me see, one share there. Here, I bought 23 shares at $55, and I was doing dividend investing, so buying a share here and there, 1 or 2 shares. But if you can see here, if I go use this one here, you can see I have an average total annual rate of return of 27%, total rate of return of 129%, which will include the dividend and capital appreciation. Now, I'm going to continue to hold Target. I don't think it's an attractive price now, but I'm going to continue to hold Target and use the dividend and reinvest it elsewhere. So again, shares was low. It picked up and it was good, but then all of a sudden it was flat for a couple years, and then it dropped lower than when I originally bought it. But did I panic? No. I bought more shares because I did my research and I knew this company is not going to go anywhere in the next 10 years. So this is why I bought more shares. So because of that, I've taken advantage of that 100% plus return so far. So again, don't panic. Make sure you do your research. And next, we're going to go with the last example of this video. So here we got T. Rowe Price Group Inc., ticker symbol TROW. So you can see here, zoom in here as well. I initially bought shares of this company at $81.76. I bought 15 shares, and then from that period, a few months later, I bought 16 shares at $72. So, and then you can see here, if we got from here to here, let's say even here, I had a total rate of return of -14. So in my portfolio, it was red for this position. And people, you may get down, man, I bought this share of this company, and what it did, it went down, right? And which basically what it did, I bought it here and it kept going down, right? And then for a few years, it was still down or flat, right? So I was negative for a few years, but that didn't mean that it was a bad buy, because I knew the next 3, 4 years, 5 years is going to be much higher. So this is the reason why I bought it. And I, again, researched the company. I like the company, the financials and things like that. And that's why I bought shares. And as you can see here, if I go from here, that average price to what it is now, I have a 14% annual rate of return, which include dividends and capital appreciation. So this one, I think by the end of this year or the beginning of next year, should be 100% rate of return. So right now I'm at 94.9% total rate of return, including dividends and the capital appreciation. So I'm not buying shares right now of this company. I'm happy with my position, Should have bought shares in March, as you can see here with a PE of 11. But I bought other companies during that March low and April low, so I'm happy with that. But as you can see, I didn't panic when I first bought here. I bought more shares, and I should have bought more shares during this time period, but I was buying other companies that I felt was undervalued as well. And because of that, I'm reaping the benefits now. And so just because you bought shares and the company drops doesn't mean it's a bad thing. As long as you did your homework, that's the most important thing. Research the company, look at this financial, and see, is it gonna be worth more in the next 2 years or 3 years than what it is now? And if you could get to that, then most likely it's a buy. And even if the company price when you bought it drops lower, doesn't mean, oh man, I made a bad decision. No, it is even more on sale because you determine that it's worth higher than what it is now. So if it drops 10, 15%, 20%, you should be buying more shares. So that's what I've been doing, as you can see with these examples. And this was the last example. So I hope you enjoyed this video and saw those 6 examples of the different companies and the price points that I bought it and where they dropped lower in prices. But I didn't panic. I bought more shares. Some I wish I bought more shares, but nevertheless, I'm happy with the current position and the money that I made. But that's just to show you the importance of doing your research, of reading the annual reports, the quarterly reports, reading analyst reporting, and looking at the financials, the balance sheet, the cash flow, and you determine what's the company fair price. How much is this company really worth? And once you determine that and you give yourself a safety margin, you should be able to make profit in the stock market as time progresses. So just because a stock drops 10-15% doesn't mean to sell it. It might mean to buy more shares because you've done your homework. So thank you for watching. If you like this video, make sure to hit that like button, as well as leave me a comment. Have you bought shares of companies that you bought initially and it dropped 10-15% and you bought more? Let me know some examples of yours. And if you're new to the channel, make sure to hit that subscribe button, and I'll see you guys in the next one. Thank you.